it is really important that you pay attention to the news. And I know a lot of people in my own life that are not paying attention to the news, and they've been really tired. And I'm going to tell you a story a little later on about how Facebook has decided now they're not going to cover as much political stuff. Oh, really? So when we're talking about 52 executive orders, you don't want to talk about political stuff. It's going to be harder to pay attention, and things are going to get more and more complex, and it's going to be harder to understand what's going on because it is so foreign to us. Tonight, I am covering this activity now that is I think the new McCarthy era. Axios did a story yesterday, how to deprogram America's extremists. The writer has called for keeping extremists out of the institutions where they could do the greatest damage, like the military, police departments, and legislatures, and providing help for those who have embraced dangerous ideologies. You notice they don't put those in schools. It's the police departments, the military, and legislature, but they don't even mention EDU. And I think that's because they know no one with a dangerous ideology, i.e. conservative point of view, is in EDU or ever going to get through EDU. Now, it is unclear as to who will determine what is dangerous ideology and what, will constitute such a defining term, but that's where big tech comes in. The article continues to say, online platforms are unwavering in their commitment to root out conspiracy theories and lies that undermine the faith in democracy. Axios spoke to experts on this. The article says banning President Trump from Twitter was a major asset in the fight to slow or reverse radicalization. The Axios article calls for a Marshall Plan, which would be implemented throughout Facebook and Twitter through censorship. It claims the United States requires, quoting, an all-out national effort to dismantle all ideas that supposedly undermine faith in democracy. It seems the writer of the newsletter doesn't understand the word democracy, or maybe they do, and they don't understand that we're a republic. Democracy is not failing us. The republic system is. A republic, you can't have a democracy. You can't. Do you want to vote on the banking rules that came out yesterday? Did you even know banking rules were coming out yesterday? There's too much for the average citizen. And that's why democracies always go to an authoritarian or a dictatorship, because they overwhelm the people. The people say, I don't know, he looks good, he can handle this. And you have democracy, votes by the public, voting in dictatorships. So there's a democracy until there's not. That's why we have a republic. But what is failing us now is our republic. Do you believe on either side, Republicans or Democrats, that your elected congresspeople really, truly are reflecting what you and people in the country actually believe? Are they carrying out the things that you believe are right and righteous for this country? Term limits. How about they can't all get rich on insider trading? Are they carrying these things out? Do you think it's cool that we're just printing money and nobody's doing anything? How about this? Do you think it's cool that we haven't had a budget for this nation, the largest, richest nation in the history of the world, that we don't even have a budget and haven't had one since 2008? The republic is failing us because we are not demanding that they actually do their work. Big tech now is the arbiter of truth. And I'm not sure what dangerous ideology is anymore as it is being defined by those in power. The idea of a conservative and a conspiracy theorist That line is being blurred. The New York Times just last year started to refer to me, it used to say, a well-known conspiracy theorist or an alleged conspiracy theorist. Now it's just Glenn Beck, conspiracy theorist. I told you yesterday that the IMF had an academic paper out, and they are suggesting now that non-financial data should be used when financial institutions determine customers' creditworthiness for loans, various kinds, by non-financial data. That means things like the type of browser and hardware that you use to access the internet, the history, I'm quoting, the history of online searches and purchases. So what kind of computer and phone I have? And the past purchases and what I'm reading, what websites I'm going to. I want to just go over. We went over this yesterday, but I want to go over it because there's new news. The most transformative innovation is the increase of the new types of data coming from the digital footprint of customers' various online activities, mainly for creditworthiness analysis. Credit scoring using so-called hard information, income, employment, time, assets, and debts is nothing new. Typically, the more data is available, the more accurate is the assessment. But this method has two problems. First, hard information tends to be pro-cyclical. It boosts credit expansions in good times, but exacerbates contraction during downturns. The second most complex problem is a certain kinds of people, like new entrepreneurs, innovators, many informal workers might not have enough hard data available, as well as even a well-paid expatriate moving to the United States can be caught in the conundrum of not getting a credit card for lack of credit. FinTech, financial tech, resolves the dilemma by tapping various non-financial data, the type of browser, hardware used, yada, yada, yada. This, of course, is a financial social credit system. We have been warning about this for years. This is one of the most dangerous parts of what is being called the Great Reset, and this is just the beginning. In the same article from the IMF later, the same authors then say the central banks need to get more directly involved in economic activity, and that more money printing in downturns is likely going to be necessary. The environment, I'm quoting from the article, the environment for monetary policy will change too. New monetary policy transmission channels will need to be fully understood as the new players make banks less relevant for the financial system. Central banks may need to adjust their monetary policy implementation toolbox, potentially allowing non-bank access to liquidity lines and incorporating them in their operations. Okay. So that's what I told you about yesterday. Do you remember when Cuomo told the banks in New York, you can give loans to gun manufacturers, but if you do, there's just going to be more regulations on you guys, and we're going to have more state inspectors because we just think there's something wrong with these gun manufacturers and gun stores. We think, that there's some violation of some law. So, we're not telling you not to loan. We're just saying that it's going to make your, state assessments every year. It's going to be more and more difficult for you because we just don't trust the people who are dealing in guns. Oh, okay. So what did the banks do? Banks started saying, you know what? We can't carry your loan anymore. Well, Donald Trump, through what's called the OCC, the Office of the Comptroller of the Currency, he wrote in that office that banks cannot discriminate. They cannot say, we're not going to make a business loan to guns. You can't do it for ideological or political reasons. Well, people have been watching this back and forth because the OCC changed hands. And people have been saying, I don't think this is going to stand. I think they're going to take this out. Well, they made their decision yesterday. Now listen to this, because this is from the OCC. So this is what they're saying. This is the government speaking. The rule codifies more than a decade of OCC guidance stating that banks should conduct risk assessment of individual customers rather than make broad-based decisions affecting whole categories or classes of customers when provisioning access to services, capital, and credit. Now, all of these rules were put in, you have to understand, in 2008 or 9 with the Dodd-Frank bills. Okay, what did the Dodd-Frank bills do? Basically, no matter what they said, they were to protect the banks that were too big to fail. So you guys have to do certain things. You can't take on risks because you're too big to fail. So there were all these rules were put there to protect the banks in many ways from themselves. Okay. When a large bank decides, I'm quoting, when a large bank decides to cut off access to charities or even embassies serving dangerous parts of the world or companies conducting legal business in the United States that support local jobs and the national economy, they need to show their work and legitimate business reasons for doing so. Okay, that's good. Show your work. As comptrollers and staff in previous administrations have made clear, in speeches, guidance, and testimonies, banks should not terminate its services to entire categories of customers without conducting individual risk assessments. Okay, so they can't just say no loans to gun manufacturers. They have to say it individually and make the case with each individual, right? All right. It is inconsistent with the basic principles of prudent risk management to make decisions based solely on a categorical assertion of risk without actual analysis. Okay, so all of this is good. Now let me tell you what the actual ruling was yesterday, and I'm reading from the document. In finalizing the rule, the agency considered more than 35,000 stakeholder comments. Red flag, anyone? As a result, the final rule excludes Section 55.1b3 of the proposed rule, which would have required that a covered bank cannot deny any person a financial service that the bank offers when the effect of the denial is to prevent, limit, or otherwise disadvantage the person from entering or competing in a market or business segment. So in other words, the rule was that they can't do it. They can't say, I don't want Glenn Beck in the media, so we're not going to give him any money. Or because the bank had a loan in some other business activity which they have a financial interest. So they're part of Facebook and I want to open up Parler. They can't do that. Okay? They can't say, no, Parler, you can't have any money because we have money in Facebook. But I want to go back to the first part of that sentence. The final rule excludes that. The agency determined that the requirement would have resulted in regulatory burdens without contributing to the primary objective of the rule. So now the Biden administration says we're trying to cut down on the red tape. There'd be too many burdens on the banks. Based on that analysis, the agency eliminated that requirement to focus on the rule of fairness, another key word, of the covered bank's decision-making process and prudent risk management principles, as well to facilitate the OCC's administration of this rule. Okay, what if the bank says, you know what, if we go into business and give Exxon all these loans, we're in trouble because of the cancel culture. They're going to start canceling us as a bank. We can't afford that. Help me out here.